Hello and welcome to this Kpler webinar. It's the 9th of December 2021, and this is going to be the final webinar from Kpler this year. So given that we are looking at 2022 just around the corner, we thought we'd have a look this morning at what's happened in 2021, how have we got to where we are, and what's the outlook for the future. So we're going to look across the energy commodity space, and we're going to look at crude, we're going to look at products, and we're going to look at LNG. After a brief introduction, I'm going to hand over to Homayoun, who's going to run us through what's happened on crude, what the outlook is in terms of supply and in terms of demand. I'm then going to do the same for products, looking at clean and dirty in east of Suez and west of Suez. And after that, I'm going to hand over to Laura Page, who's our senior LNG analyst. And Laura's going to look at the very interesting situation right now on LNG, what's happening in that market as we head into the winter. So a brief summary of the catalyst for 2022. How do we look across those three sectors? Well, the bullish oil price factors, and just highlighting a few here. Onshore oil inventories are at a 2-year low, and China is likely to resume rebuilding of the inventory over the course of the year. Additionally, OPEC plus upside potential appears limited in the short term. We saw the announcement last week, but Homayoun's going to go into more detail in terms of what that means for the markets over the coming months and the year. In terms of bearish oil price factors, well, obviously, as we all know, the world is raging about Omicron, and new COVID variants remain the main risk. Across to the product side, on the bullish factors, well, demand recovery continues in certain developed economies, particularly in the US and in Northwest Europe, and that's especially the case in petchems and gasoline. Speaking of petchems, Chinese propane dehydrogenation capacity growth is definitely a highlight and looks likely to continue. And again, I'll go into that in further detail during the presentation. On the bearish side, well, clearly jet fuel demand is still very depressed. And according to IATA, the International Air Transport Association, is not expected to grow until 2023. And on the LNG side that Laura is going to explore in more detail, clearly there's potential for a cold Northern Hemisphere winter that would be very bullish for prices. And we're also entering winter, or Northern Hemisphere winter, with low European gas inventories. On the bearish side, looking at the factors that could affect price there, well, obviously, there could be a mild Northern Hemisphere winter that actually means reduced demand. At the same time, we've got slowing economic growth in China, and we've also got the potential for fuel switching in the power sector, particularly in Asia. So having looked at where those bullish and bearish factors sort of sit on a high level basis, I'm going to hand over to Homayoun, who's going to talk us through the crude scenario. Homayoun.
Thank you, Kevin. So indeed, I'm going to focus on the oil market, which has seen quite a robust recovery through the year. We started the year with WTI and Brent at around $50, $55 a barrel, and now we're at $75 for Brent, which is a 40% increase. So a healthy increase, even though it's not really comparable to the crazy year that we've had for natural gas, coal, and power. So I guess we can start by looking at inventories, as this is a good snapshot of where things stand right now. The storage has been drawing heavily throughout the year, as you can see on the chart. So the chart here shows you the level of oil inventories across the world stored onshore in blue. That relates to the left-hand scale. So we're currently slightly under 3.4 billion barrels. And the orange line shows you floating storage that relates to the right-hand scale. And we're currently at around 127 million barrels. So as I was saying, draws have been massive this year. We've been back to pre-COVID levels for a few months now already. In fact, we're currently at a more than 2-year low now, as you need to go back to September 2019 actually to see similar levels for onshore storage. So unsurprisingly, most of the draws took place in the US and China, two countries that hold the largest storage capacity. However, this is now actually stabilizing in these countries. We haven't seen inventories build again in China in Q4 this year. So moving on to floating storage, the orange line, hasn't decreased by the same magnitude as you can see, but there is one main reason behind this. So out of the 127 million barrels currently stored offshore, so in floating storage, about 90 million barrels is oil from Iran and Venezuela, so countries that are still under US sanctions, which makes the stocking of their crude and condensate quite difficult. Now, obviously, the price curve explains much of the reason why we've grown so much this year. Brent and WTI have been deep into backwardation since late 2020. The market has actually generally been quite tight through the whole year. So this was primarily the result of OPEC Plus cuts, but it's also linked to other large producers' inability to boost output significantly throughout the year. So a good indication of that tight market probably is net exports. So net exports is simply the difference between the level of oil that's being exported against volumes that we see being imported. Now, if we focus on the seaborne trade, we see that net oil exports have been negative at an average of 900 kbd in 2021. So by negative net oil exports, what we mean is that there have been more imports than exports, just simply as that. And that difference, again, has been of 900 kbd in 2021. Now, however, the situation we think may be flipping because imports have overtaken exports in the past 3 months. And this actually happened only twice in the previous 8 months of the year. So that seems to indicate that we may have hit an inflection point on storage and that we're not going to go much lower in terms of inventories. So on the next slide, we're going to see, we're going to have a closer look at the supply situation and whether additional supply is going to help build inventories again in 2022. So let's start with the US shale sector, as this could actually once again become a hot topic for supply growth in 2022. So what you can see on the chart is exports, not production. And you have to bear in mind that there's usually a lag of a few months between production and exports in the US. So as you can see on the chart, exports stabilized in 2021, but the Midland grade, which you can see here in dark blue, so that's the grade produced mostly in the Permian Basin, that grade is showing an aggressive growth since the middle of this year. So despite both production and exports starting to grow again, we're still down by 1.5 million barrels per day compared to the highest level seen at the end of 2019. Now, however, with WTI currently around $72, $73 a barrel, shale players in the US are in a much stronger position than last year. So firstly, they showed great capital discipline since the beginning of the COVID crisis. And you probably know that it's something they were not famous for before. So that's a real structural change in the industry. If you look at company results in the third quarter, dividend increased 4 times more than investment. And this was welcomed by shareholders. And we got a proof of that when oil prices recently fell from above $80 a barrel to less than $70 a barrel in the past 2 weeks due to Omicron. The performance of shale oil companies in those past 2 weeks has outperformed the oil price decrease. So coming back to production, current growth in the US shale patch is around 100 kbd per month. And that's up from just about 40 kbd in the last summer. So that's mainly driven by the Permian Basin, which should reach back its highest production levels in December already, so this month. However, that story is quite different for the Bakken or Eagle Ford. Now, for next year, we expect production to increase by around 800 kbd on average in 2021, with most of the growth posted in the first part of the year. So we see weaker growth in the second part of the year, as we'll start seeing production decline from the new wells that have been put into production in the first half. Inflation potentially could also impact production growth in the second half, as well as reduced efficiency. The more production is brought back, the more growth we'll have, the more older equipment will also be brought back into the sector to help sustain production growth. And that's why actually we believe that there will be strong dynamics for the US oil services sector on the equity side. So companies like Halliburton and Schlumberger are likely to benefit from the need to revamp equipment in the sector. Looking at exports, about half of these go to Europe. So the growth there is mostly going to impact OPEC players such as Algeria, Angola, Nigeria, Iraqi Kurdistan that export mostly to Europe. By the way, looking at Asia, oil trade with China has been very weak at just 70 kbd in 2021, and we think that's a good indicator of the worsening relationship between Washington and Beijing. So on the next slide, we'll see that the other driver for non-OPEC countries are mostly offshore plays and Canada. So we also see important production potential in the rest of non-OPEC, but less than for US shale. So that's mainly due to the fact that short-term sensitivity to oil prices is lower in those countries than it is in the US. So as you can see on the chart, we're also looking at exports. We're pretty much back to pre-COVID levels. Although growth in 2021 has been quite disappointing with just an increase of 200 KBD year on year. However, for 2022, we expect production growth and exports to be higher. So we expect about 500 KBD to be added on top of what we have had so far in 2021. And that's mainly going to be driven by Norway, Guyana, and Canada. So in Norway, output from Johan Sverdrup could increase by about 200 KBD, thanks to the second phase of development entering into operation. So that would boost production to 750 KBD from the field at the end of the year, next year. Elsewhere, Guyana also has very impressive potential over the next few years. As you know, new discoveries keep being made in the country, and proven reserves in the countries increased to above 10 billion barrels. And that simply puts it as the third largest oil country in South America after Venezuela and Brazil for reserves. So production there will triple next year with the second phase of the Liza project coming on stream. So we expect the second FPSO Liza Unity to enter into operations by the end of the year, by the end of 2021. And for 2022, that's another 220 KBD of oil that we see being produced from Guyana. Excuse me. So moving a bit north, we see production from Canada's oil sands to increase as well by about 200 KBD as well. That's mostly driven by efficiency gains that have decreased break-even prices for new projects there to $60 a barrel. So production from oil sands in Canada is already at the highest level, and we think the momentum should continue, as this was highlighted in earnings by some companies such as Cenovus Energy. So the only place in the main non-OPEC countries where we're not so positive for 2022 is Brazil, where we think oil output is expected to retreat by 100 KBD due to asset sales and the ongoing impact of the pandemic. Presidential elections are also to be held at the end of 2022, and this probably will not impact operations positively neither. So beyond 2022, we think the potential remains limited from these places, apart from Guyana and Brazil, where more investment could lead to another 1 million barrels per day of production by 2025. So all in all, looking at non-OPEC, we have US shale adding 800 KBD, and we have these countries adding 500 KBDs in 2022. So we think it's another 1.3 million barrels that will be added on top of what OPEC is going to add. And that brings us to OPEC plus. So I think it's fair to say that 2021 was not a confirmation year for that, OPEC plus confirmed it was back. And obviously 2020 was key, but the group thoroughly managed the market this year, and except the little spat that we had seen between the UAE and Saudi Arabia in July over numbers, used for reference production, we haven't seen major disagreements from the group. The group actually managed to preserve market stability, and their choice of words has been really spot on. If you remember, back in early November, OPEC Plus refused to boost supply beyond what was initially agreed, despite international pressure. And they did so by saying that we're not done with COVID yet, basically. 3 weeks later, we had all the fears around the Omicron variant that took the market down. So they had anticipated it well. Likewise, if we look at last week's meeting, they stuck to the initial plan. And by simply adding the words that the meeting remains in session, quote, they managed to prevent oil prices from falling further. And we think they've effectively put a floor on prices in the medium term at around $68, $69 for Brent. Obviously, unless a new COVID variant comes and wreaks havoc. So when looking at exports, those actually didn't increase that much in the first 8 months of the year. So if we look at total OPEC plus exports, excluding Iran and Venezuela, so we exclude these two countries because our estimate for these two can be quite volatile. depending on the month, and also because anyway they're exempt from the agreement alongside Libya and Mexico. So if we look at total OPEC plus exports, that's what you see here on the chart. Compared to the last quarter of 2020, exports were lower in the first 8 months of the year, 2021, by about 200 kbd. And that's why production at the same time was supposed to increase by 2.3 million barrels per day in the same time frame. So that kind of changed with a big increase in exports lately, mostly from September. And actually since September, we've seen exports increasing at a pace of more than 700 kbd every month. Now, however, for some countries, we think the upside potential is actually quite limited from here. So we've worked on an OPEC plus production model that takes into account other variables such as refinery runs, variations in inventories, crude burn, sometimes pipeline data, and so on. And we think that, for example, Russia is already at around 10.5 million barrels per day. That's only 500 kbd lower than their reference production number. In other places such as Iraq, Iraq has had stable exports over the past 3 months. And we think this could be linked to regional issues, and especially Iraq's dependency on Iranian gas and power imports for their own power generation. So Iraq imports about a third of its power generation needs from Iran in the form of natural gas or power. And that has been hit by Iran's internal issues. So Iran actually has cut its power exports and natural gas exports to Iraq to a minimum. So the effect of that is that Iraq has had to divert more oil domestically to produce more fuel oil and use that as a feedstock for its power plants, therefore limiting its exports. Elsewhere, looking at Russia, Saudi, and the UAE, the 3 main countries, these 3 countries are able to add 2.4 million barrels per day between now and September 2022, based on the agreement. But as we've seen, Russia's potential is quite limited from here. And while for the 2 other members, Saudi and the UAE, we are seeing a much larger potential to increase production and exports. But actually, we don't think they'll be able to make up losses elsewhere, such as from African members. Just as a reminder, between now and the end of September next year, OPEC Plus is able to add a bit more than 4 million barrels per day in production. So lastly, on this slide, there's a growing dichotomy between these larger members and the smaller members, and especially those in Africa. Exports from West Africa are actually still 800 kbd lower than in 2019, and they're even lower than in 2020. They're about 450 kbd lower than in 2020. In fact, if you look at Angola's exports, they've hit the lowest level in decades last month in November at under 1 million barrels per day. And that situation is not likely to improve for these countries anytime soon. So that's something else to have in mind when looking at OPEC plus dynamics for next year. So lastly, on the crude side, after looking at supply, I think one of the other major factors impacting the market next year will be Chinese demand. So let's focus on that. The Chinese waterborne imports dropped to multi-year low of 8.2 million barrels per day in October. Actually, this year in 2021, China really has chosen to draw down onshore inventories through the year as prices have risen, rather than buy at higher prices. So onshore inventories have dropped by levels of around 140 million barrels to about a bit more than 800 million barrels. That's what you can see here on the chart. However, they've started climbing since the beginning of Q4, and that corresponds to Chinese imports ticking a bit higher. So it appears that China is not really willing to let inventories fall below pre-pandemic levels of 800 million barrels. Looking ahead, we expect Chinese seaborne imports to rise, not just because of the recent price drop and lower inventories, but also because of the approaching Lunar New Year in the country and Winter Olympics. And also because, there's also the fact that China has plenty of spare refining capacity to boost runs to meet both domestic and regional demand. They've also added close to 1 million barrels per day of new refining capacity in the past 3 years. And finally, ongoing lockdowns remain very strict in the country, showing you that there's really an upside potential here. Just so you understand, a traveler getting to China needs to quarantine for a period of between 4 to 8 weeks, 4 weeks minimum, and sometimes up to 8 weeks, depending on the city. So the impact of localized lockdowns in China is still hard to quantify, but we think that over 2021, probably over 200 million people were ordered to stay at home for between 2 weeks and 3 months. So showing you all the impact that this could have had on products demand. So as a result, for China, we expect seaborne imports to challenge the record pace that we had seen in 2020, so which was about 10 million barrels, rather than be lower than this year's, which is at 9.6 million barrels. So we expect an uptick in imports from China. So that's the view we have on crude. And Kevin, sorry, I've been a bit long. I'll let you develop our view on products.
Thank you very much, Homayoun. So we're going to turn our attention now to the other side of the barrel, the other side of the refining complex, and look at what's happened and what's happening and likely to happen in terms of product output. So starting with light distillates in the east of Suez region. And this chart here shows Asian naphtha imports by destination country. And you can see it's dominated really by the East Asian countries, South Korea, Japan, Taiwan, and China. And the important thing to note is that in the second half of 2021, we've actually seen naphtha imports into the east of Suez region reach higher than pre-pandemic levels. So this is a very good sign about the robust health of the petrochemical industry in the region. In actual fact, what's really driven that has been both a demand for personal protective equipment, PPE, for health workers and frontline workers, but also other consumer goods. It's well known that trade has increased and container freight is under pressure because of the amount of consumer activity that's going on. And that's been very bullish for the naphtha market. Looking individually at the countries, South Korean imports are actually up by 11% versus the 2019 average, even though they dipped ever so slightly in 2020. The story in Japan and Taiwan is actually quite similar. They're both up in the low teens versus 2020, but they're up by almost a third in the case of Japan and over a third in the case of Taiwan versus 2019. So clearly, again, very strong signals of the petrochemical activity in those two countries. China, however, has seen a slight drop in imports by 4% year on year, but they're still 19% up versus 2019. And a large part of that is that Chinese ethylene production has started to be fed more by US ethane than ever before. Excuse me. China has the largest demand for ethylene in the world, but also has amongst the world's highest ethylene production costs. And Chinese ethylene producers have effectively attempted to reduce that cost by turning to alternative feedstocks. So they've turned to ethane at the expense of naphtha, which explains why the imports are down year on year. But all of this tells us that the outlook for petchem related demand is strong. We're going to see this continue. I'm going to talk about LPG in just a moment, but generally the outlook for petchems across the region is very healthy. Getting slightly heavier, looking at middle distillates east of Suez. And on this slide, we decided to focus particularly on Chinese clean petroleum product exports, because I think there's a very interesting story here. And that's that as of the second half of this year, from sort of June into July onwards, we saw a big change in Chinese output. Now, some of that was caused by reduced refinery throughput, which reduced exports of gasoline and also of diesel. But actually, there was a bigger factor at play, and that was that the Chinese government introduced a new import duty that put light cycle oil imports on parity with finished grade diesel. Now, the reason that they did this was because independent retailers and blenders were importing LCO from South Korea, blending it into the Chinese domestic diesel pool and selling it, and effectively creating for themselves a better margin than those seen by the state-owned enterprise refiners. The government closed the loophole by, as I say, bringing LCO import duty into parity with finished grade diesel, and that closed the incentive, that removed the incentive for those imports. The impact of that on the market was to reduce the number of molecules effectively available in the domestic diesel balance. And because Chinese refiners and suppliers prioritized domestic demand, that meant there were fewer barrels to export. So the impact of that on the external market was that gas oil and diesel exports in the second half of 2021 versus the first half were down by 68%, down 170 KT from over 2 million tons a month. 160 kbd is where they sit currently. And we can see that on the extreme right of this chart, going into Q4 and looking into Q1 of 2022, we're going to see a continuation of this pattern. The Chinese government has a history of changing import duties in order to close these creative loopholes. We've seen it in the past on power kerosene for the diesel market. We've seen it on mixed aromatics for the gasoline market, and we've now seen it on LCO for the diesel market once again. So once these import duty changes happen, it's unlikely that we would see any sort of retraction of that import duty, and therefore we're unlikely to return to the pre-duty levels. It's worth noting as well that gasoline exports were down 26% year on year, but also down by 47% in the second half of this year versus the first half of the year. And that was really driven by crude import quotas for the independents being cut by 35% in the second quarter. On the other side of the coin, Chinese jet fuel exports are up 29% year on year, and we're up 33% in the second half versus the first half. But it's worth noting here that we're not really seeing an uptick in jet fuel demand. I'll come on to that more in a moment, but it's more about the comparison with the base load. What was the factor that was the base load of export that created this possibility for an increase? So it was really very low exports in 2020 that allowed us to increase so specifically or so spectacularly. Looking at petchem feedstocks east of Suez, and we've got a running sum chart here really to show East Asian LPG imports. So it's the same countries again. It's Korea, China, Japan, and Taiwan. And we can see that 2021 LPG imports are up 9% year on year. We've got a very strong trend. And actually, I mentioned just a moment ago about Chinese naphtha demand, LPG demand, and ethane demand. Well, Chinese LPG imports are up 22% year on year. And that's been driven by Chinese propane dehydrogenation growth and also growth. An additional 4.4 million tons of new capacity has come online or will come online by the end of 2021, which means an additional 3.2 million tons a year of propane demand. And just to give an outlook of where we're going with that in the future, over 30 new plants are planned between 2022 and 2025, which will mean an additional, well, more than an additional 30 million tons of new capacity. Japan and Korea, well, the situation in Japan and Korea, as I just mentioned a few moments ago, is that imports are up overall versus 2020, but they're actually down versus 2019. And that's really been affected by naphtha. So the Japanese and Korean crackers have been importing more naphtha, as I mentioned just a few moments ago. So we're going to shift our geographical focus to the west of Suez and look first of all at the light distillates market. And the chart we've got on this slide shows the arbitrage, effectively the transatlantic gasoline arbitrage from Northwest Europe to the United States. And the important thing to note is the sudden spike that we saw in arbitrage import numbers in March and April of this year. And that was created by the winter freeze that swept across the US Gulf Coast, specifically Texas and Louisiana. It took out power generation capacity, and as a result, that restricted refinery throughput. And so we saw this sudden need for imports into the Atlantic seaboard, or the eastern seaboard, the Atlantic coast. Now that carried on into driving season. There was limited time for effectively recovery of inventory. However, even though we had that pressure effectively on demand and the incentive to import, 2Q21 imports were still 17% lower than 2Q 2019. They were, however, significant. They were more than double the level we'd seen in 2Q of 2020. Really driven by the fact that in 2020, as we all very painfully remember, that was the start of lockdowns, that was the start of restricted mobility, restricted industrial activity. Excuse me. So 2Q21 was very much comparing with a very low base in 2Q 2020. Demand recovery has continued in the third quarter and is likely to continue to recover into the fourth quarter and into next year. But I think this is also due to the fact that we've seen what I call a Thanksgiving bounce. People are traveling to see their families, and therefore we've seen increasing gasoline demand. And that's very much a feature of the third or fourth week of November every year. High retail prices, as we all know, have created an incentive for arbitrage traders. They've been above $3 a gallon on average since June and are still at that level as we head into 2022. So despite those high prices, we still expect demand recovery to continue. We still expect the US to be driving much more, and that will certainly be the case as we go towards the driving season, and so we'll see a build in 1Q of 2022. Getting slightly heavier once again, turning to the middle distillates market west of Suez, and we chose to look specifically at the market because we've got a very interesting emerging picture. And this chart shows monthly imports of jet into OECD Europe by destination country. And the first thing to note is that very clearly 2021 has not been the recovery that perhaps we expected. Imports have only totaled 1.3 million tons per month, and they're down by 43% versus 2019 and are still down by 22% versus 2020. And on the extreme right of this chart, and probably going on further than this chart goes into December and January, certainly in the UK, we're feeling it as of the announcements yesterday evening, there's been an impact of resurgent Delta, but also of the fear of Omicron. And that's creating that's led to some restrictions, and that's created lower demand for jet fuel. And I've mentioned the ARA corner because obviously that's the supply point for some of the key jet fuel consuming countries in the region, i.e. Germany, Switzerland, the Netherlands, Austria, all of whom have restrictions around movement, and therefore we think that there's likely to be ongoing demand destruction in Europe into the first quarter of next year. Excuse me. UK imports in particular, where obviously London Heathrow sits as one of the big hub airports of Europe, are down by 54% versus 2019 and still down by 28% versus 2020. So clearly, as I mentioned, Omicron, a new threat. It's an ongoing threat to passenger aviation. However, it seems that even though there is higher transmissibility, the severity of this particular variant may be lower. So there remains a bit of a question about whether or not the fear and the restrictions are a slight overreaction. Now, I just want to highlight the forecast from IATA, as I mentioned at the start of the show. The International Air Transport Association only sees demand recovery in 2023. We're only going to get to 105% of pre-pandemic levels in 2 years' time. And looking at petrochemical feeds, and we've chosen to focus on the main story in the region, and that's US LPG exports. And we can see on this chart, we've broken it out into exports by destination continent, but we've also given you the delta, so you can see the year-on-year change in those exports in particular. And we've also broken it out into the destination countries by percentage. And the first thing to note is that over the last 4 years, effectively, US exports have climbed by 55%, up to 4.3 million tons. And that picture continues to be dominated by Asian importers. They make up 53% of the total and are up by 67%. So this really bears out what I was saying about the strength in Asian petrochemical demand, in Chinese, in particular, PDH, propane dehydrogenation. Exports to the Americas, stable since 2019, really not a lot to see here. However, Europe is up by 13%, but down by 7% year on year. And that's because of the competition from Asia, i.e. Asian netbacks are effectively higher than those from Europe. And as a result, European imports from the US are down 7% year on year. As I said, we've given you the deltas to show just how strongly US LPG demand has grown. And it's been a positive picture throughout 2021, apart from during that February 21 Texas freeze. Going into next year and beyond, there is still a very solid outlook for continued growth in exports to Asia. And we're going to see that, I mentioned the increase in PDH capacity in China, over 30 plants, over 30 million tons of capacity. So that's also a very bullish story for the US LPG export picture. The products round up without looking also at fuel oil. And we decided in this section to look in particular at East Asian fuel oil imports, and again by destination country. And the key point from this slide, this sort of retrospective slide, is that we've seen a significant demand growth and a significant import growth in the second half of this year. And that's been driven by, obviously, power generation demand. We're going to see that continue into the winter. It's been driven also by LNG prices. So spot LNG prices, obviously, as you know, and Laura's going to talk about this in more detail in just a moment, are very high. And that's driven some countries to fuel switching. We've seen that in Bangladesh, we've seen it in Pakistan, and we've seen it in countries further east as well. So that's also been very, very supportive for fuel oil itself. Additionally, global container freight strength. As I mentioned earlier, we've seen a lot of consumer good movement, and we've seen a lot of movement in general, and that's driven demand for bunkers. And that bunker demand is not going away. And in particular, if we look at the bunkering demand in China for both very low sulfur fuel oil and high sulfur fuel oil, it's grown enormously. It's taken total fuel oil up by 14% to 1.8 million tons a month of imports into China alone. However, and I mentioned earlier that the independent refiners had their crude import quotas cut, and that's driven them to import more straight run fuel oil, up to 300 KT per month in the second half of this year. And that's up from 50 KT in total, not per month, in the first half. As I say, all driven by quotas for the independents. Looking across the region, South Korean fuel oil imports are also up 29% year on year, and that's really been driven by reduced refinery crude runs, making fuel oil availability domestically lower, and therefore it's driven imports from the wider market. As we go into winter, or as we go deeper into Northern Hemisphere winter, high spot LNG prices have driven interest in fuel switching, as we see, and as Laura will explore in more detail in just a moment, and that's likely to continue. So speaking of Laura, I'm going to bring her in now to talk about LNG and the outlook for, or where we've come from, and the outlook for LNG markets in the near future. Laura.
Thank you very much, Kevin. So yes, we will turn to the natural gas markets now, and whether you've been following these markets or not, I'm sure many of you are aware that gas prices in Europe and also Asia have been trading at record highs in recent months, and that's before winter has really got started. So it's really quite an interesting time for the market right now. So I'm just going to take a quick look at where we are in terms of pricing and how we got here. So if you look at the chart on the right, you'll see the JKM price in orange, which represents the price of LNG cargoes delivered into Northeast Asia. So the big importers like China, Japan, and South Korea. You'll also see in blue the European gas price. Now, these prices have really been climbing rapidly this summer and into early winter, and have far overshot the levels witnessed last year when we were at record lows through the summer. So we have gone from record low prices last year to record high prices this year. And how did we get here? Well, it's been a number of factors really, and to put it quite simply, we've seen really strong demand from Asia, Europe, and also South America this year, which has led to a fight for cargoes. On the LNG side, supply side, production growth really hasn't been as strong as expected. We've seen a bit more maintenance happening this year due to COVID delays. And a number of production disruptions as well, particularly in the Atlantic. So supply has really struggled to keep pace with demand, and that's led to tough competition for LNG and a rise in prices. If we go to the next slide, one thing that we need to look at going into 2022 is European gas storages. Now, the rebuild in storage levels this summer was very slow, and Europe went into withdrawal season this winter with storages at just 77% full. Now, this is well below the 5-year average of around 92% full. On top of that, I was looking at the storage numbers for November, and we drew down at the fastest rate since records began. So we've seen a lot less Russian pipeline supply than previous years, and we also had a cold second half of the month. Now, this is certainly something to watch out for on the demand side next year, as it will be a really crucial determiner of the TTF price. Now, the chart on the right-hand side shows that with storages where they are now at around 66 BCM, and assuming withdrawal rates of previous years, we would be on track to end winter with storages well below 10 BCM, which is around 10% if it was a cold winter like 2017, 2018, when the beast from the east hit. Now, there are a lot of caveats to this, as obviously it assumes all else is equal. But if you add another layer on top of this, and that's the assumption that Russian flows could continue to come in below previous year levels, this could look quite worrying. We don't expect the new Nord Stream 2 pipeline, which would flow gas from Russia directly into Germany, to come online this winter due to delays certifying the project. So certainly we do need to keep an eye on these Russian flows as well. Now, what low storages would mean is further upside potential to the TTF as it tries to price in some demand destruction and also attract more gas supplies. And depending on the strength of LNG demand in Asia, we'd expect some of this upside pressure on the TTF to feed into the Asian spot prices, as Asia really needs to compete with Europe for Atlantic basin supplies. If we go to the next slide, so what could help the situation in Europe? Well, certainly Russian pipeline supply would, if we had more Russian pipeline supply, that would help, as well as a mild winter as well. But on the LNG front, what would help is a slowing Northeast Asian demand and additional LNG supply. Now, I'm going to focus on the supply side here, and I've put together a list of projects that are expected to come online over the next year. And we have nearly 24 million tonnes of additional LNG export capacity, which is due to come online between now and the end of next year. 15 million tonnes will come from the US, which will see the country become the world's top LNG exporter next year. We've already seen a cargo being exported from Sabine Pass Train 6 this week, and we'd expect to see one coming from the new Calcasieu Pass plant over the coming months. We also have an expansion in Tangguh in Indonesia that will finally come online after some COVID-related delays. And also Mozambique will become an LNG exporter for the first time, with the Coral South FLNG now on its way to the country. It's also important to look at existing capacity, which has not performed particularly well this year. You'll see at the chart at the bottom of this slide that we didn't get that much production growth this year over and above 2019 levels. As I mentioned earlier, we had more maintenance and a number of production disruptions as well. The biggest production losses we've seen has actually been in the Atlantic, so places like Nigeria, Trinidad and Tobago and Norway as well. There was also a fire at the Prelude FLNG facility in Australia recently, so that could be offline for some time too. So certainly this is something to keep an eye on, as additional supply will help meet a potentially another strong year for LNG demand if this winter turns out to be a cold one. So yes, let's head on to the summary and have a look at what we've discussed today. So Homayoun mentioned at the start of the call today that on the crude side, inventories have declined to a 2-year low, but we could be at an inflection point as supply increases in the first half of this year, especially US shale and the rest of non-OPEC output. OPEC Plus still holds the key to market stability, but is unlikely to deliver 100% of its output growth. Kevin spoke about petrochemical demand is keeping both naphtha and LPG markets quite well supported. Jet fuel demand is still struggling and won't normalise until at least 2023. Bunkering, power generation and straight run cracking are all supporting the fuel oil markets. And then, as I mentioned just now, on the LNG side, we really need to keep an eye on European storage levels and those Russian pipeline imports into Europe, as this will be a key factor for the TTF market in 2022. And also keep an eye out for that new LNG capacity coming online, which will support production growth next year. Over to you, Kevin, for the question time. Thank you.
Thank you very much, Laura. I'm very conscious of the fact that we've reached 9:47, excuse me, about pretty much the limit of our 45-minute allotted time this morning. We have had some questions. What we will do is we will respond to those questions personally. We will also send out to a recording of this presentation and of this webinar to everyone who registered. So all that remains really for me this morning is to say thank you very much for your attendance. I wish you a happy and peaceful and healthful holiday season, and we look forward to seeing you in 2022. Thank you very much and goodbye.